everyone. This is Prateek. I'm from Antique. Hope everyone is staying safe and healthy. On behalf of Antique Stock Broking, we welcome today the management of All Cargo Logistics, Mr. Partha Sarthi, who is Vice Chairman, Mr. Deepal Shah, Chief Financial Officer, and Mr. Ravi Jakar, who is Chief Strategy Officer. Without wasting much time, I hand over the call to Mr. Ravi for his opening remarks, and then we will move to Q&A session. Over to you, sir.
Thanks, Prateek. Good afternoon, everyone. I hope all of you and your families are safe and healthy. This is Ravi Jakar here, Chief Strategy Officer for All Cargo Logistics Limited. On behalf of the company, I extend a very warm welcome to all the participants for this third quarter FY22 financial results discussion call. Today on this call, I have with me Mr. Partha Sarthi, Vice Chairman, All Cargo Logistics, and Mr. Deepal Shah, Chief Financial Officer, along with our investor relations team and advisors. I hope everybody had a chance to go through our investor presentation and press release uploaded on stock exchanges and the company website. I would like to begin with introducing Mr. Partha Sarthi, a much-awarded professional, thought leader, and votary of transformational change with over 35 years of rich experience. He has previously served as the Group CFO and Group CIO at Mahindra Group, a chartered accountant, and an alumnus of Harvard Business School's Advanced Management Program. I would now invite Mr. Partha Sarthi to give his opening remarks. Over to you, Mr. Partha.
Thank you, Ravi, and thank you, Deepal and Ravi, for having me in this call. I'm delighted to be with you after some hiatus, okay? So, analysts and me have a long history, being the Group CFO for Mahindra for almost a decade, interacting with you, and I always loved these sessions. And also, in a sense, it's very déjà vu, so in that sense, to be present in this call today. 21 years back, a little more than 21 years actually, I came in from Delhi to Mumbai with a vision of making a tractor company world number one. So, and that was a journey which was very exciting, and I did that journey being part of the transformative journey that happened. And today when I again, like, don't stand, but I sit before you, I could say with a lot of warmth and a lot of delight that there is another transformational journey underway, being the world's number one, another Indian company, Indian MNC, taking that path, already achieving part of it. The key thing that they want to do is not less than the laurels, and want to clearly be the leader of the LCL business globally. And that's what is the thought, and that's what they are headed towards. And in whatever small way I can be part of the journey, I'll be delighted to be so. So that's what delights me being with you today morning. And then the environment that I see is one of great positivity. Yeah, we are poised to turn around and be an 8 to 9% growth GDP next year. So that itself augurs well. And the GDP and the logistic industry have a reasonably close coordination, you would tell me rather than my telling you. And whatever has been done, I call it the important announcement of the budget, IMP, integrated logistic, multimodal, transportation and grid creation, and PM Gati Shakti. So the IMP makes it important and pivotal for logistic industry to really soar along with the India Inc. and India as a country. Coming to the people, I think the part of the beauty of being in a transformation is that this is the first group that I've seen where digital is Intel inside and marketplace outside. And they have embedded digital in each function and each unit. And when it comes to outside, they are thinking of marketplace as one. I have been delighted because the CIO, not the IT part, the information part, but as an IT head, the CIO in me is delighted with this approach, which I'm seeing in action. Many people talk about it. I see this in action, and it will be my pleasure to be part of that journey with them and cheerlead that so that it brings the key differentiator in times to come. Okay. So then the next small thing that I want to see, and then I want to stop. Otherwise, both Deepal and Ravi are already looking at me saying, you talked enough, you should stop, and I should. So, but last point that I want to make is that board is really energized in terms of taking them towards next bet. Management is already doing on the volumes and revenue and profit. So that will be a focus area, but that's others to carry. The board is very focused on bringing diversity. So I'm delighted that 3 women are on the board of Alcargo. They are very focused in terms of ESG and governance, and that they are delighted with the new directors also which is coming in. And I've always been saying that the word should change from 3P, which is profit, planet, and what? People. Okay, 2P plus 2P, which says that people and planet are the end cause, and the process of profit and process of governance should be the means towards that end, and that brings governance, and that's the governance we would like to focus on as we go on. And with new board members also coming in, this will be well enabled in your company. So with that, I will stop and say that all this make Alcargo very good, and the journey that they are taking is from good to great. Thank you.
Thanks, Mr. Pathasarthi. I would like to share brief updates about the business in terms of the underlying performance and the macro conditions before handing over to my colleague Deepal for a detailed financial update. As you are aware, we recently announced the scheme of demerger under which the CFS ICD business would form part of All Cargo Terminals. This is a business which we have seen there's been a bit of a mix-up environment. On one hand, we have opportunity in form of trade growth. On the other hand, we have had constraints and challenges with the Omicron wave coming in and disrupting operations. And that's been largely the scenario across all businesses. But I think somewhere in the background of challenges and opportunities, we have tried to focus more on the opportunity and deliver performance. In the CFS ICD business, the recently acquired PD Multimodes continues to add significant strength to the company, and that acquisition is being integrated right now from IT systems to processes, and we believe that it should continue to provide strong momentum for growth. We continue to evaluate new opportunities on the ICD space and keep an eye on the development of the dedicated freight corridor, which would truly open up the opportunity for setting up and expanding the ICD business, particularly along the western line. As part of the demerger, as you're aware, the real estate part and the equipment business is being hived off into Transindia Realty, and I'm happy to inform that our logistics park business continues to perform well with the macro environment being very favorable. There's a huge demand for grade A warehousing, and there are ample opportunities for that business to continue to expand and grow and see significant demand coming in for soon to be ready, which is already leased out, and potential additional capacities which can be created. And on the equipment business, we are again seeing success with our focus on specific category of equipment, and also looking at a combination of outsourced and owned equipment to drive an asset-light approach. And the overall market environment has also been favorable. We are seeing an upcycle in infrastructure projects, and all of that would mean that our equipment utilization would continue to be high, and people would talk more specifically about where that has been in due course. Apart from these two businesses, in the continuing all cargo businesses, we have Gati, which we have spoken about on the Gati investor call as well. The transformation journey continues, and we continue to see new records on revenue and also improved performance in terms of service to clients, and that is something which should continue to drive positive momentum. And on the contract logistics side as well, again linking back to the whole requirement for grade A warehouses, there's an increasing demand for contract logistics operations as well in e-commerce, and for us on this business which we operate through ACCI, we're also expanding into new verticals. Started off as a chemical-focused company, expanded into auto, e-commerce, and other domains, and we see that continued opportunity to leverage the existing capabilities and expand into new domains, and that's something which holds a lot of promise. Coming to the largest and the main business, which is our international supply chain, which operates under the EQ Worldwide umbrella. In that business, basically over the last 2 to 3 years, we started on a transformation journey. And that is a business which is a combination of LCL and FCL. And we were focused on driving growth. And there are many ways in which a company can drive growth. The most important was the organic growth. And through various transformation initiatives on sales acceleration that we undertook, we saw extremely positive results in creating a new benchmark in those specific countries. And we would have more countries covered as we move forward, but there is an illustration of some broad indicative impact on these countries where such initiatives are undertaken, and we've been able to significantly expand our market share on the base of sales acceleration. The other opportunity for growth for us has been the acquisitions, and it's almost been in the DNA of the company, and which means that we have been very proactive. And with that proactive approach, we have managed to find strategic opportunities which are value accretive because they are extremely synergistic. And I'm happy to share that our most recent acquisition of Nordicon and the joint venture that we set up in Korea are both performing tremendously well, and they give us confidence to continue to explore growth through acquisitions. We have also had successful integration, because acquisition is not just about acquiring the company, but I'm more glad to share that the integration of EQ Nordicon, which was not part of our network, has been extremely successful, and they have seen growth in volumes. Usually whenever such integrations happen, there's a slippage, but in this case we managed to outperform the earlier performance. The third avenue for growth at EQ Worldwide has been new product launches, and we started with our FCL journey, and the result is there for all to see what we have achieved in the last 7 to 8 years, and we believe that now, following similar lines, we could explore other opportunities, and at this point in time we are evaluating how we could expand our presence in the air business, which is relatively limited at this point in time. So on one hand, you have growth on the back of these diverse strategies, and then there's a multiplier impact which gets created by way of digitizing the customer endpoints. EQ360, which started off as a nascent platform a few years ago, is now an extremely mature cloud-based platform. We used to have a single-digit percentage of our bookings on EQ360 little over 2 years ago, and today we have nearly 35% bookings happening on EQ360, and if we add back the other digital interfaces, almost 54-55% of all export bookings in EQ Worldwide are today happening digitally. And with this digital front end to the customer, it means that we can grow rapidly without having to invest behind expanding our SG&A cost base. And we do not stop utilizing technology on the digital customer base, but it is equally important to automate the back-end processes and bring in significant efficiency. And be it booking processes, tariff management, route management, we are bringing in technology, standardization and processes and automation in every step that we can. And that has allowed us to post a robust volume growth over the last 12 months without having to significantly expand the underlying infrastructure or people. And we believe that similar trends would continue as you will be able to create further operating leverage on the back of automation and digitization in EQ Worldwide. So with an overall transformational approach, driving growth in all possible ways and digitizing the front end and automating the back end is creating a far more efficient organization which can continue to grow, and on the back of robust trade growth that we are estimating in the coming years, we believe that our market leadership in LCL business at the global level would continue. We would further cement our position, we would continue to expand in other categories and gain market share. So I'm glad that that's the kind of trend which is there across all businesses, wherein we are poised to gain market share, and at the same time we continue to focus on divesting non-core businesses, and we are making good progress on that as well. On that note, I would now hand over the line to my colleague, Mr. Deepal Shah, to update you on the financial performance for the quarter. Over to you, Deepal.
Thanks, Ravi. I will now discuss the Q3 financial year 22 performance. All Cargo reported a revenue of rupees 5,869 crores for the Q3 FY22 as against 2,735 crores in the corresponding period during the last year, higher by 115% on a YOY basis. EBITDA was higher by 242% on a YOY basis at 505 crores as against 114.8 crores in the corresponding 148 crores in the corresponding period during the last year. PAT was higher 252 times on a YOY basis at 355 crores as against the 1.4 crores in the corresponding period during the last year, including a 30 crore share from associates and JV. The earlier PAT, just a clarification, earlier PAT for last year had an exceptional of 21 crores. Even if we adjust that, the PAT still was up by 16 times. Coming to the 9-month performance for FY22, for the 9 months ended December 31st, 21, the company reported a 14,296 crore of revenue as against 7,149 crores in the corresponding period during the last year, which is higher by 100% YOY basis. EBITDA was 146% higher on a YOY basis at 1,084 crores as against 441 crores in the corresponding period during the last year. PAT was higher by 711%, stood at 724 crores as against 89 crores in the 9-month performance of FY21. The record performance has been delivered by success of transformational approach led by exceptional leadership of the management team across businesses. The company put strong focus on attracting and retaining top talent across the world. Further, the company has demonstrated strong performance on acquisitions. There has been a strong contribution from surge in digital revenues and cost optimization through automation across end-to-end processes. Now I'd like to discuss the performance of each business segment in detail for the quarters, starting with the MTO segment, which is the international supply chain. The international supply chain business witnessed sustained growth on back of volume growth and expansion in market share in favorable market conditions. Transformation continues to drive sales acceleration, value addition across the trade lanes, has also witnessed share of door-to-door component in the business. Digital initiatives with industry leading platform Q365 continue to provide superior service experience to customers. MTO segment reported a revenue of 5,202 crores, higher by 142% YOY against 2,147 crores from the corresponding quarter last year. EBITDA stood at 420 crores, a growth of 373% as compared to 91 crores in the corresponding quarter last year. On an annualized basis, ROCE improved to 72% in Q3 FY22. Coming to the CFS ICD segment. The CFS ICD business continues to deliver good performance. We continue to consolidate market share across key gateway ports of India, and acquisition of multimodal handles has further added strength to the overall business proposition we offer to our clients. Volume handled for the quarter stood at 1,47,433 TEUs as against 81,666 TEUs for the same quarter last year. CFS ICD vertical reported a revenue of 177 crores, growth of 62% year-on-year against 109 crores in the corresponding quarter. EBITDA stood at 43 crores as compared to last Q3 FY21 of 36 crores, registering growth of 18% YOY. Coming to the Express Logistics business. The Express Logistics business under Gati's umbrella, the subsidiary which is GKEPL, reported its highest ever volume and revenue at 353 crores, higher by 20% YOY against 294 crores in Q3 FY21. The highest ever tonnage of 2,65,000 metric tons for the quarter, a growth of 11% against volumes in the corresponding period for the last year. Digitization of Gati helped us transform business to the growth path, and it would continue to witness momentum entering 2022. Coming to the contract logistics business. The contract logistics business continues to demonstrate resilience with revenue and profit showing significant growth in the quarter. The business is under ACCI, where All Cargo owns nearly 61% shareholding. ACCI also has customs clearance business, which is undergoing a scheme of demerger and is at the NCLT stage. ACCI witnessed a growth of 26% in revenue to 187 crores and EBITDA increased by 25% from 28.4 crores in Q3FY21 to 35.4 crores in Q3FY22. The company manages approximately 5 million square feet of warehousing area under its operations. Coming to the warehousing, the AMC business, which is the rental and others business, and of course the project segment as well. Project and engineering segment and the logistics segment. I would first give an update on the projects and engineering segment. The revenues stood at 87 crore, growth of 6% YOY, while on the project side, there were execution challenges that impacted the overall growth. Exit utilizations of our equipment division stood at 2-year high levels of almost 80%. We have been maintaining a stance of coming out of low yield, loss-making equipment and increase our dependence on third-party outsourced assets. Revenues from logistics park continues to trend above rupees 20 crores for the 4th consecutive quarter. With continuous demand of global and Indian MNC tenants for grade A warehouses, the occupancy level remains stable and earnings visibility in this segment remains very strong. The revenue for Q3 of FY22 grew by 27% YOY to 22.6 crores. With this robust performance, 9-month annualized ROCE stands at 22.5% and net debt to equity ratio stands at a comfortable position of 0.25 times. Now I would request the moderator to open the line for Q&As. Thank you so much.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question at this time, please press star 1 on your phone. We have the first question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
The business that we are having looks to be like a very valuable business. So how do we actually capitalize on it and compete against the likes of delivery or even the other new age digitally enabled logistic companies?
Sorry, somehow we did not hear the first couple of words of your questions. If you could just repeat the first part of your question again, please.
Sir, the Gati business now looks very valuable to us, and in the ground that we have lost against people like delivery or other digitally enabled logistic companies.
Yeah. So I would just briefly respond to this, but I would also request participants to keep the questions to other businesses since we anyways have a separate call for Gati. But just to quickly respond to your question, there are 2 segments in the express logistics. One is B2B, wherein Gati, PCI Express, Safe Express play, and the second is B2C e-commerce, which is where you have delivery, e-com express, Amazon transport services, etc. So in the B2B domain, yes, like I said, there is a positive momentum on the back of whole e-commerce as well as the GDP growth, and we continue to see great opportunities for Gati's continued expansion. And like I said, across all business segments, which includes Gati, we are confident of increasing our market share and therefore growing faster than the market growth rates.
And since new age digitally enabled companies, particularly e-commerce, are getting much better valuations, any chance of having a kind of a buyback or something where we could get much better valuations there?
There are no
There's
such.
still a very big difference between our valuations and the valuations that
No, so
funds are giving.
yeah, so we don't comment on valuations because valuation is a perception of actually giving it. But we were very clear that we want to create long-term stakeholder value for all our participants, and we don't look at short-term valuation gaps. So that is our approach to the business, and we are here to stay and we are here to grow. So if there is a short-term valuation mismatch, it's not something that we would like to comment on.
Thank you, Ramesh.
Just as a aside, because I can't not comment when I'm sitting there. So Ravi and Ripal, especially your excuse, I just say that every company in his arsenal has many options, right? Yeah? And it is the company's intent to use all the arsenals for the benefit of our stakeholders. Absolutely. Yeah? If we start saying we'll be predicting the future, the purpose is to explain the performance, not to predict the future.
Absolutely.
Okay.
Yeah, thank you, Mr. Baswadi, for that comment.
Thank you.
Yeah.
We have the next question from the line of Keshav Garg from CCIPL. Please go ahead.
Sir, many congratulations for excellent numbers. Sir, I just wanted to understand if you could just let us know that, sir, in our MTO division, there has been a tremendous growth, sir. How much of it is due to the tailwinds provided by the realization growth? And it's already mentioned that we had healthy 21% volume growth in LCL segment. Sir, but what I want to understand, sir, that is our approximately 390 crore of PBIT that we made in MTO segment in last quarter. How sustainable is this going forward, and how much of it is due to the industry tailwinds and the realization growth?
Yeah, so I would provide some color on that. Like I said earlier, the growth at EQ Worldwide is driven more by market share expansion, which means that it is unique to EQ Worldwide and not purely driven by market tailwinds. Further, the consolidation business is where we are capturing cargo which doesn't fill up the entire container, and therefore what happens is when we are able to significantly expand volumes, we are able to increase utilization as well. And while we are charging customers for the cubic meter of cargo that we carry for them, our purchase is of the full container that we book with the shipping lines, and we operate like an Uber on an asset-light approach. So as the business grows by such strong volumes, it leads to increased utilization, and that has a significant operating leverage impact. So as far as the LCL business is concerned, the entire benefit is coming from improved operating leverage, utilization, and the volume growth. On the FCL business, there would be a combination of improved procurement, because as we are gaining larger scale, our procurement improves, expansion into profitable trade lanes, and there will be an impact of favorable tailwinds as well. It is difficult to substantiate or quantify, but we believe that, like I said, the tailwinds do not impact the larger LCL segment at all, and in the FCL segment they have some role to play, which should be taken care of through the organic growth which has been happening in the segment as well. And therefore, I would comment that the performance is sustainable, is what I would leave it at.
Sir, but if we see that in our MTO segment, sir, consistently we were making around 4% of PBIT margin since many years, and now this has doubled suddenly. So I appreciate all your initiatives like increasing digitization, etc. So, but still, sir, is it that once the rates normalize to what were prevailing pre-COVID, then still we would be able to clock this kind of operating margin?
So if you notice, while the EBITDA margin has improved, it is a very small part of the overall revenue and cost, and therefore the operating leverage has a much more significant impact in this business as compared to any other business. So on the gross margin side, if you notice, in fact we have had a reduction in the gross margin in this business on a percentage basis, which indicates that it's not a benefit coming in from the created environment. And to take an example, the 1 to 2% improvement in utilization in a container itself can have a significant impact if you do the mathematics on that increase being, that's the additional revenue that one could generate without incurring any cost. So you just add 2% revenue without adding any cost of a container. That will give you some sense of, how each initiative can be powerful by itself. And then similarly, if you look at the EBITDA to SG&A cost ratio, you could also see it's a business driven by people. So when you are able to automate operations, it creates a significant leverage because then effectively you're adding that entire business without having to incur additional SG&A costs as well. So there are multiple operating levers that play at the operating margin, at the staffing costs, admin expenses, which is all translates into this.
So Ravi, just to add, so your yield improves once you jump over the break even. Any improvement in the capacity utilization will add to the bottom line directly.
Absolutely.
That's what's happening. Which is very clear. And we've sustained a fair amount of growth in terms of volume over the last 1 year. So we are quite positive, I would say, that much of this is sustainable.
Okay, sir, that's very reassuring. And so lastly, just wanted to understand that so how do things look as we stand now in the fourth quarter and also looking ahead? Sir, how's the freight rate environment? Sir, are you seeing some dip or are these rates sustaining?
So we could comment on the present state, and we know that there are 3 to 6 month contracts being signed in the market, which indicate that the operating environment is likely to remain similar. Beyond 6 months, there is no concrete visibility on the contracts being signed because contracts are usually of 3 to 6 months in nature when it comes to rate contracts with carriers. But from a macro trend perspective, there are 2 or 3 things which one could note. Significant consolidation in shipping lines. There are perhaps almost 12 to 15 shipping lines which were there 10 years ago and do not exist anymore. There's been a whole focus on sustainability, which means that there are multiple regulations restricting usage of old ships, speeds at which ships can travel, and multiple other things as well. And in terms of inventory order book, we understand that there are additional supplies which may start coming in from early next year. But overall, our sense is in the short term, the market environment may remain similar, and there could be some correction in the medium term. We do not anticipate the freight rates going back to the pre-COVID level, but they should settle at a new normal.
Okay, sir. Thank you very much.
Thank you. The next question is on the line of Prashant Kumar Hazariwala from Solitaire Financial. Please go ahead.
Hello. Yeah, good afternoon, sir. Congratulations for such a great performance. Hello?
Yes, I can hear you.
Yeah, can you listen me?
Yes, sir, we
we can hear you. Sorry.
Yeah, okay, all right. So my question is on the same kind of question that the previous participant has asked. So we used to do 10% kind of operating margin before 6 years or 7 years, right? So after 2017, I think we have first time came back to 9% of operating margin. So what are the probability of increasing the operating margin from here and sustaining about it?
So I would say that, on the operating margin, like I said, the utilization levels have been improved, which have allowed us to improve the operating margin. So on the LCL business, the margin should sustain, and there will be an endeavor to further improve. On the FCL side, it's been a combination of operating freight environment and scale. The operating environment would marginally change, causing a negative impact, while the scale would make a positive impact. And on the back of the volume expansion, I would say that the overall operating margin profile should be more or less steady from these levels. And I would also like to point out that there could be some minor fluctuations on a quarter-to-quarter basis because of seasonality in the trade. You typically around the Christmas time, there's a significant surge in trade on the trans-Pacific trade lanes with a significant amount of cargoes being shipped, while there could be a certain period of lesser cargo flows around Chinese New Year, etc. Some of those seasonal flows kick in, but from an overall perspective, the operating margins in percentage terms on the LCL business should be steady. On the FCL business could see marginal decline over a period of time, but should be more than compensated with the volume growth, is how I would largely put it.
Yeah, so most of the gain came from this MTO business, right? And we have sold some project and engineering equipment too, right? In this quarter, 400 crores kind of thing, right? So
that's
what kind of loss we can...
Transport business? That's the project cargo transport business, which is a part of the T&E segment.
All right. So what kind of loss it has done during the last year or last quarter? Whatever we have sold, right? So I just wanted to know that what kind of loss we can seriously by selling this stuff.
Yes. No, so we've not had any losses in project division. There have been, what do we say, some long-standing receivables, because some of these project companies, deal with all these energy and EPC companies, which take a little longer time. But apart from that, we've not had any large losses on any of the project division. But the ROC and the whole business, the ROC is not, at the moment not, this thing. So we were, in which case we wanted to focus on more asset-light business. That was our strategy. That's the reason we kind of moved out of that business.
Yeah. So basically, we as a group have decided to focus on a certain category of businesses, and which is why, from our perspective, it made strategic sense to exit that business, while that business may also continue to offer opportunities. But, it does not fit into the strategic scheme of things for us, and therefore we decided to exit business, and this is something which we've been stating for quite some time.
All right, right. So we can see now. So our project and engineering business is profitable on the operating side, right? That is what you are trying to tell me. And whatever losses are, we are showing it because of this receivables problem, right?
Yeah, and also what you're referring to, losses to some extent in some quarters will be largely driven by the depreciation as well in the equipment division. So you're looking at at the PBT level, wherein depreciation of this equipment has been a significant number. But at the EBITDA level, the businesses have performed reasonably well.
Yeah, at EBITDA level, none of the businesses are at loss. We have these equipments which are at a very, we are having accelerated depreciation, in those equipments. Generally, they have almost a 30-year life, but we have an accelerated depreciation ranging from 10 to 15. So because of the higher rate of depreciation that we've applied, the PBT is at a loss, but at EBITDA level, we're not burning cash anywhere.
All right. Thank you very much. Thanks for your answer.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. Now, so just wanted to understand, some sensitivity of the freight rate, basically. Now, if tomorrow freight rate decline by about 10%, or maybe a particular number, 5 to 10%, so how does that impact our margins or the profitability? So some sense, if you could just provide, would be quite helpful.
Sorry, I didn't hear the word before the trade. What trade did you refer to?
What?
You refer to the trade decline. Which trade decline did you refer to?
No, I'm talking about freight rate. If there is freight decline.
Yeah. So like I explained earlier, our LCL business, which is the mainstay business, is a business of consolidation, and it's not a pass-through cost business. We run the world's largest LCL network, and like I highlighted, the gains in the bottom line can be entirely matched to the increased utilization levels, which are driven by the volume expansion. So they are not dependent upon the freighted expansion. So if you were to look at the yield on a cubic meter basis, the entire upward tick has happened on the back of utilization. We do not consider ocean freight. It's almost like a pass-through cost. When ocean freights decline or ocean freights increase, we do not get any positive or negative impact in the mainstay LCL business. The impact comes in largely from the utilization levels, because that is where the cost leverage comes into play.
Absolutely. And we do expect our utilization level to remain buoyant, right? Given the kind of growth that we are seeing globally as well as within the country.
Yes, we are quite confident of sustained utilization levels on the back of growth and also initiatives. For an instance, we have a senior industry professional who joined us recently primarily to drive yield management at a global level. We also have been setting up a data science team to work on yield management network optimization. So there are many technology-led initiatives as well, because ultimately, as a logistics company, our purpose is to make efficient transportation of goods, and we are committed towards that. And in the process, we would continue to endeavor to improve the utilization, which has a positive impact for us and also for the trade at large.
Understood. And in one of the previous participant query, you did mention regarding the EBITDA margins now, the volume addition advantage to be somewhat negated by some environment change, and you expect your EBITDA margin to remain stable at the level we currently are, right? So here, just I wanted to know what environment change we are talking about here that can negate your volume addition. Is that the freight rate or something else?
Freight rate, yeah. I refer to the freight rate decline over the few quarters, which, as I explained, due to lack of significant consolidation, various regulations, the operating environment is not likely to go back to the pre-COVID level, but a marginal impact of that would come on a part of the business. So therefore, there could be some negative impact of the radical change in operating freight rate environment, but that is what I was referring to gets negated by the kind of volume expansion we have been demonstrating year on year for quite a sustained period in that business.
Okay. Understood. So that's quite helpful, sir. All the very best. Thank you so much.
Yeah, thank you.
The next question is in the line of Chetan Shah from Abacus Asset Management Company. Please go ahead.
Hi team. Thank you and congratulations for the superb result. Just one quick question. Can you just kindly explain me this MTO business, if you can help us understand in terms of the price movement? You very nicely explained that how the break-even point and beyond that, the profit which we make directly flows down to PBT. But if one wants to understand in terms of our existing capacity post all the acquisition, does our break-even numbers have changed, or how do one look at it in terms of the volume growth going forward? If one wants to take a 2 or 3 year time horizon.
Yeah, so just to give you a quick, overview on that, typically it would be on a container basis, and it will be on a trade lane to trade lane. We operate about 2,400 direct trade lanes and several thousand other indirect transshipment trade lanes. But on every trade lane on a particular container, you would say have an X%, I'm just using a ballpark number, let's say at 65% utilization, you break even. Every percent utilization above 65 adds to your profit. Or in some trade lanes it could be a 55, in some trade lanes it will be 75. But clearly what happens is that because your profit is kicking in after, let's say, 65 or 70% number, as you move from 80% to 85, the impact on the profits is much more significant than the 4-5% impact. That is how the business operates, because you're committed to incurring all the costs that has to be incurred for carrying that full container, while the revenue is generated based on how much cargo gets carried inside.
Yeah. I think this was a perfect thing which I was looking for. If I may allow to ask one last question, that will be very thankful, please. So I just wanted to understand that if one looks at the volume data pre-COVID when the normal world was there, but the shipping rates were quite dismal, and post-COVID things went haywire, but now the shipping rates are coming back to normal, so does the volume of the business on a global scale. So if you want to look at it, how normal is the volume vis-a-vis the pre-COVID level? I'm talking about not the price, but the volume of the container on a shipping line movement. If you can give some color on that, and how do you see this changing in next couple of years time horizon?
Yeah, so I think, broadly speaking, if you look at the port volumes, which are a good indicator of global trade, different countries have had different points in time when disruptions happen. China impact came in Feb 2020, India impact came in FY21 because it was largely between April to June. So, on a one global consolidated number, it is difficult to predict, but I would say except for the COVID-led temporary disruptions, the overall trend on the trade continues to be positive. And if you look at any of the forecasts on world economy or global trade, they're all very positive for the next 3 to 5 years. And I would leave it to those experts to comment upon the trade growth rates.
Thank you so much, Ravi, and all the best to the team, please.
Thanks, Chetan.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Yeah, sir, I have 2 questions. Firstly, is there any update on timelines of scheme of demerger for our business?
So we have provided for the detailed timeline estimates in our investor presentation as well. But broadly, we are looking at about 12 months if I were to put one number to it. But there are some details in terms of stepwise process, etc., which you may refer to in our investor presentation.
Sure. And also, can you give the net debt number as of December 21 close?
Sorry?
Net debt number. I see we have gross debt number in the presentation.
Yeah. So net debt is around close to 1,400 crores.
Okay. And sir, any update on timelines of the Blackstone deal, or it's still sort of slow versus what we discussed 2 months back?
Same comment as last time. Things are not in our control, and we'll update as soon as we see any decision on that.
So we've received the extension letter from Blackstone for March, and we are hopeful of completing by that time.
So we remain sort of confident of closing the deal by March 22.
As you're aware, it's related to some government approvals. So we are pursuing it, and we cannot comment because it's beyond us. We cannot comment an exact timeline. But as far as construction is concerned, most of it is already completed. Leases have started. We've taken some lease rentals also, LRDs also against some of these properties. So everything is working in as planned. Some approvals may take some time, and we're cognizant, and so is Blackstone about that. So.
Yeah, so these are things like Rebel said beyond our control, but just to reiterate, the business continues to perform very well. The construction has been timely, the leases have already been signed, the operating revenue continues to grow, and these are all high quality grade A warehouses leased by marquee clients for real long term, and this is the segment which is seeing significant demand. So on the business side, it has been absolutely great. And only the transaction on, which is more of a, I would say, at a shareholding level, which has been pending due to some approvals pending. But we, at this point in time, again, it's a similar update. Perhaps it could happen in a month and a half. Unfortunately, the government functioning, has an impact whenever there's a new surge in COVID cases, and that has kind of, affected us too. But we remain hopeful that now we are seeing the end of COVID and government functioning should return to normalcy, and we should see this through as well.
One question on, you talked about new products like in form of air segment. So in what time horizon we can expect some meaningful contribution to the MTO segment, as well as we would be looking at some M&A to upstart in the segment?
So we are primarily focused on organic growth at this point in time, and we have started building out the air business in a few select offices, and it should start to grow, over the next 2 to 3 years. But naturally, sitting inside a large ocean freight business, it would appear insignificant for quite some time because the healthcare and SL business itself is also growing. But I would say business by itself should attain some decent scale over the next 3 years or so.
And last question on project logistics, as we are now looking to sell this business as well. what will be the annual sales which will get shipped out from P&E segment related to this business?
150 crores. 150 crores. Annual revenue you're talking about, right?
Annual revenue, EBITDA numbers.
Yeah, so annual revenue will be close to 150 to 200 crores, which is what will shrink. And EBITDA will be around close to 8 to 10 odd crores.
Sure, sir. I'll get back with you. Thank you.
Thank you. The next question is from the line of Radha from BNK Securities. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, my question was with regards to this slump sale in the project logistics business. So I understand that it is a part of P&E segment. So with respect to that, what is the capital employed of just the project logistics part as of December 21?
The capital employed will be close to 70 odd crores.
Okay.
70
okay, thank you.
75 crores. I don't have the exact number, but yeah, around close to 75 crores is the capital employed only for projects other than equipment.
Yeah,
so
only
that's
for
approximately.
Yeah, only for project logistics, the part that we are selling off.
Yeah, also I would just like to add further to that on the project logistics business we have sought the approval from the board, and we will be signing the agreement in the due course of time over the next 4 to 6 weeks, and we would share more details at the time of signing the agreement as well. We may not be able to share some details since we are in the confidentiality bound period as well. So we'll share more details on all the aspects of the transaction at the time of signing of the agreement, which should be any time in the next 4 to 6 weeks.
Okay, thank you, sir. Sir, just my last question. So, in the MTO business, the major driver for this quarter was realization growth rather than volume. So, and you said that with respect to the freight rate environment, it will be marginally low. I mean, as compared to COVID levels. So, going forward, can we assume that there will be major growth factor for this MTO business will be volumes rather than realization?
So the business would continue to see sustained volume growth, and if you look at an year-on-year basis, there has been a strong volume growth as well in this quarter. And as I mentioned, the realization is driven largely by utilization levels, which will continue to remain high, and you'll continue to see sustenance in these levels.
Okay, thank you, sir. That's it from my side.
Thank you. The next question is from the line of Shailesh S. from BNK Securities. Please go ahead.
Yeah, thanks for the opportunity. So what is your capital allocation plan for the next 1 year, and also how the debt will pan out?
I believe you're referring to CAPEX plan for the next 1 year?
Yeah.
We couldn't hear you clearly. Can you repeat it more clearly?
No, what is our capital allocation plan for next 1 year, and how the debt will pan out?
Capital allocation. Okay. So on the capital allocation, primarily, like we said that, our investment, so we will continue to look, we don't have any large plans for any inorganic growth, but if there are smaller opportunities available, in more particularly in the MTO space, we wouldn't be shy of allocating some capital there. On the CAPEX side, we do not have any large outlays except for maintenance CAPEX and some transformation related, CAPEXs which we will incur over the last 1 year. Other than that, the rest, we do not have any large, big bank plans for capital allocation, and we will see how the cash will be utilized.
However, the CAPEX allocation is based on and good returns.
Yeah. So, of course, we have the dividend yield and the returns on the capital employed in our mind when we allocate capital going forward. So currently, the business is growing. It requires higher working capital. So our capital allocation will look at focusing on partly reducing debt, improving, adding some more working capital and improving yield on all of these items. So these will be primarily our objectives.
Yeah, and just to give a color of strategic priorities, we are very focused on asset-light approach, which means that we will not be investing behind, capex-heavy assets across any business, and we are significantly focused on return on capital employed. So any capital allocation from here would be towards an initiative which creates an improved ROC for the business.
Absolutely.
Now, can we expect around 200 crores, 250 crores debt reduction in this year? Next 12 months?
I couldn't hear.
Can we expect 200 to 250 crores of
debt reduction? Debt reduction.
Debt reduction.
Yeah.
In next 12 months, for sure.
Okay. Also, what is the total identified non-core assets to sell in next 1 year? With the amount, can you share, please? Across all the business verticals.
So basically, the non-core asset approach has largely been shared about Gati, when we had indicated that we have approximately another ballpark 150 crore worth of non-core assets, which is an update which was shared. It has been constantly being pursued, and this is the total ballpark number, including the quarter gone by in the next 4 to 5 quarters. That is how I could put it. On the all cargo side, it isn't about non-core assets, but about gradual reduction in capital employed on the businesses that we do not see as core.
Okay. So also, can you please update on Blackstone deal? Any timeline to close the deal?
We just responded to that 5 minutes back in detail. We would update.
Okay. Thanks.
Thank you. The next question is on the line of VP Rajesh from Banyan Capital. Please go ahead.
Thanks for the opportunity, and really appreciate you explaining the business levers in detail. Just on the Blackstone deal, is my understanding correct that after that deal gets done, our debt will come down by around 500 crores, or has that number changed?
No. So our debt there'll be a combination of two things. So our debt number will come down by almost 300 odd crores.
300,
because
okay.
some of the debt, so there will be two parts to it. One will be the LRDs which you have taken in the SP will move out of our fold and move into Blackstone. And there will be some OCDs issued to Blackstone which will get converted into equity. So we are expecting around approximately 350 odd crores of debt reduction directly from Blackstone deal.
And also just to highlight, there is an optionality as well in that. So that is referring to what is definitive part. There is one logistics park which is an optional asset which would have a further impact of an equal proportion, but that's something which has not been concluded yet. Once we conclude the first part, and we cannot share details beyond that, but we would update once we see the consummation of the transaction.
Right. So what you're saying is after this first phase of the deal is done with Blackstone, then you will be down to around 1,050 crore of net debt on the books, right? And you're saying in addition, if there is a logistic park deal, then the debt could come down further by 300 crores or so. Is that my understanding correct?
That's correct.
And then, okay, so for the projects business that you are divesting, what has been the interest level? And, as you are sort of closer to signing a deal, what is the sort of valuation expectation you have? Meaning, if the book value is around 75, could we expect that the value realized could be around 150 crores from that?
We've already given the value, and like we said earlier, we cannot unfortunately discuss this, because we're still in the process. So due to confidentiality reasons, we cannot discuss too much around that.
But the number is already mentioned.
The number is already mentioned. 101 is what is already mentioned in the outcome.
Oh, I'm sorry, it's 101. Okay.
Yeah, it's already mentioned.
Okay, so the book value for that business was around 75 crores. Is that right?
So like I said, these are estimates. We don't have the exact number.
Understood. Okay. So that money which will come in, will that also go into the debt reduction, or you have plans for other uses for that cash?
Yeah, it will go in for debt reduction.
Okay.
But the money is, there's a structure to which the money is going to come. So I think there are a lot of elements to the deal which we cannot discuss on this call at the moment.
No, fair enough. I totally appreciate and understand that. But it's good to know that what I'm in a sense, and if you can corroborate that, is that you are essentially moving to a very asset-light business.
Absolutely. So in the long run, we want to create 3 buckets which you explained in the demerger process. We will have an asset heavy, which will be the Trans-India business, which will be, which will carry some warehouses in that and the land parcel. CFS, primarily the business, the all cargo terminal, will be asset-light model. They'll be leasing out most of the assets that they are operating with long leases. And the MTO business, which stays back with Gati, will actually be the asset-light business. That is how we very clearly explained in our demerger note. And whatever non-core assets that we are carrying, or assets which are low in yield, like for example, some cranes were low in yield, and some assets in Gati, is what we are trying to monetize and try to use that money to reduce debt or to allocate that money for better business, in businesses which perform better. That's how we are looking at it.
Understood. Okay. All right. Appreciate that. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Ravi for his closing comments.
Yeah, thank you all for joining us for the conference call, and we hope we've been able to answer your questions. And I would recommend that you also take a look at the investor presentation updated on the company's website on the stock exchanges that provides deeper insights into some of the growth plans and the operating levers and about the overall business strategy as well. So I would highly recommend that you take a look at that. And thank you for joining us on this call, and I wish you safety and good health to you and your family. Thank you very much on behalf of all of us. Thank you.
Thank you.
Thank you very much.